right, welcome everybody to accounting. Today we're going to go over chapter 1, which is going to be the introduction to accounting. All right, so let's actually talk about what this class entails, what is accounting, and especially what are the aspects that make up accounting, especially because what we are learning here, okay, is the very basic fundamentals of accounting, which is financial accounting. We're starting from the very, very beginning as if we don't even know what accounting is or never heard of accounting. So in this case, what are the sections, what are the topics that we are going to be looking over in this class? We are going to be looking again the basic principles of accounting, which is going to be collecting, okay, recording, journalizing, and posting trial balances and things like that, balancing our books, okay? I'm going to teach you the accounting equation, right? And the rules that govern accounting, which is going to be the generally accepted accounting principles, okay? I'm going to teach you the merchandising activity of a type of business where we're going to be looking at purchasing items and turning it around and selling them, okay? So when we talk about the different three business activities, our main focus is to show you the merchandising. How do we purchase? How do we sell? And of course, how do we collect that sales, right? How do we charge sales tax? Okay? I'm also going to show you how to even create financial statements. And last but not least, I'm going to show you what it's like to have payroll, right? Have employees, pay them, etc. So in this case, very bottom basic line of any typical small business that exists is going to have these key fundamentals, right? So again, expenses, purchasing, income when we sell our products, other things such as like payroll and so on and so forth, okay? So we will be dealing with the three individuals or people that are involved. So again, your vendors, your customers, and your employees, all right? So let's go ahead and talk about the different business organizations, okay? First off, let's talk about what is the most crucial point of a business, and we call this the nature of a business, where any kind of business organization has the purpose of getting raw materials, okay? And taking those raw materials and somehow converting it into a product or a service for the general public, okay? And again, if you think about real world, right? A lot of these businesses tailor to a specific market, or they tailor to a specific group of individuals, right? A niche, we call it. And those kind of, aspects is that the purpose of it is to provide a service or a product that is unique to the company, right? Something that makes customers want to come back and continue purchasing that product, right? But the ultimate goal here is really, if you really look down to the core of a business organization, they are in the running to make a profit, okay? They're here to make money, right? They're here to maximize profits while maximizing savings. So that means they're gonna buy a product, that's super, super cheap, okay? And however they either make it unique, whether they repackage it or something like that, they're going to add a price to it. And then their ultimate goal is they're trying to exceed their profit margins without with cutting a lot of costs, okay? All right. So again, we're talking about the nature of a business, okay? That the ultimate goal of any kind of business is they want to make money, okay? So maximizing their savings, meaning cutting their costs down to very, very low. And ultimately, how much money can they make? If they can purchase their items at $1 and sell it back around for $10, that's the ultimate goal of a typical profit kind of business, okay? Their goal is to make money. Okay? So let's go ahead and talk about the 5 different business types that exist, okay? We got sole proprietors, okay? We got partnerships, corporations, limited liability companies, and last but not least, we have our non-profit or non-for-profit, whatever one that you recognize that one as, okay? All right, so these are usually the top 5. There are other smaller businesses that do exist, but these are the typical 5 that you would commonly see here nowadays that actually currently exist. Okay, so we'll break down each and every single one with what they are, what their advantages and disadvantages are. Okay, starting with the very first one is sole proprietor, hence the word sole, meaning one person. Proprietor is going to be someone who owns the company. So in this case, one person and one person only. Okay? Now, in this case, right, that means this individual, okay, not only do they own everything that is in the business, they are the only ones that are in full control of the business. Okay, so that means they're the one that's managing the business. They're the ones taking care of everything. Okay? And of course, if they own the entire business, that means all the assets, all the liabilities, and all the earnings is going to be owned by the owner itself. Now, in this case, when we are looking in the government's eyes, a government will treat the owner and the business as one entity, okay? Meaning there is no separation between the owner and the business, okay? So that is the number one rule here, is that anything that you own or owe or anything that you generate income for, it is all going to be for the owner. Now, of course, the IRS is also going to, kind of be aware of your kind of business, especially because the ultimate goal is to make a profit, right? Now, anybody could say, I can make a business so I can do it for the purposes of tax purposes. No. It is not that easy. Especially if the IRS decides to give these sole proprietors a specific criteria, right? And that criteria is that this business must make at least a profit 3 out of the 5 years of doing business, okay? If it fails to do 3 years profit out of the 5 years, that business becomes a hobby. And again, hobbies cannot be tax write-offable, or tax deductible, okay? So in this case, right, again, anybody can say, oh, I am my own business. I own my own business. No, there's a lot more logistics than that, right? You need to invest money into your own company. You need to apply for a business license. But again, if you're using that to take advantage of your own taxes, just know that you need to make a profit at least 3 years out of the 5 years of doing business, or else the government or the IRS is going to see that as a hobby, okay? And again, if you were to take those taxes off the first couple of years, they'll come back at you, audit you, and then they'll basically take that money back, okay? So again, make sure if you are going to decide to go into business, know the rules and regulations, okay? So what are the advantages versus the disadvantages of being a sole proprietor? Number 1, It is the most easiest and less expensive way to establish your business, right? Or to even start up your business. Now, here in Nevada, okay, I believe, I don't remember what the website's called, but you can apply for a business license pretty easily. It's online, right? And usually it will get approved within 30 days, okay? And it's about like $100 right now for a business license. But again, it is the easiest and the less expensive to actually create your own small business, because again, you and the business are one. So in this case, it's the most easiest to establish and the one to start up right away. Okay. Number 2, owner has full control of making all the decisions to run the business. So again, a lot of people say, I don't want to be, told what to do. I rather do what I want to do, right? Run my own business the way that I like it, right? And that's the thing. The owner has full control of every decision, every business decision that you want to make, right? Because you and the business are one, meaning you make your own decisions, right? You want to buy this, buy that. You have full legal rights to do whatever you want. So that's the good thing, because again, not many individuals like to be told what to do or have, decisions made for them. They want to make all the decisions, okay? Number 3, owners can keep or reinvest all profits that are earned from the business. Now, in this case, again, the purpose of a business is to typically make money. Now, again, as the owner of the business, whatever dollar that you earn from the business is 100% your money. Okay? So that means, again, the owner does have the option. Do they want to pocket the profit or do they want to reinvest in their company? Now, best rule of thumb, and it's a recommendation, okay, you don't have to necessarily listen to me or not, or anything like that, but it is recommended that you should reinvest money back into your company, at least for the first year, because what that money can do for your business is it allows you to expand, it allows you to market more, it allows you to upgrade your equipment, make yourself more sellable, okay? Build your brand up, build your quality, let people know about your, product / service, right? So the best thing that you can do is reinvest into your company, but that doesn't mean you have to put all the profits in. You can pocket some of them for yourself, okay? But you want to be very, very careful about that, because if you are the owner, right, you are also responsible for every liability. And we'll talk about the disadvantages in a second. But that is the cool thing about owning your own business, is you get to take all the profits, or you could choose to reinvest into your company. Okay? Number 4 is the one that everyone loves, which is a personal tax write-off deduction. Yes, because you and the business are one, you can write this business enterprise, whatever you want to call it, organization, you could take it off as a personal tax off of your own tax. And of course, you have to file a separate tax for the actual business itself. So in this case, right, because you own a business, I believe it's called the self-employed section of the business on your taxes, you can claim because you're taking a loss on this business, or you're taking whatever it is, right, that you need that money to for the taxes to, help your business out. Okay, so it's a huge tax break for the individual. All right, and last but not least, it is the most easiest to dissolve. Right, close up your bank account, tell the IRS that you are no longer a business. Boom, you're done. Right, nothing you need to do except for liquidate your assets, of course. But other than that, easy to dissolve. Okay, if you don't want to do a business anymore, you're able to opt out very easily. Right? Now let's compare the disadvantages of being a sole proprietor. First one is you are 100% responsible for any liabilities or debt. So again, we said that the owner, right, can take money out from the company at any given time or profit all the, pocket all the profits, right? In this case, now that is a dangerous kind of thing you want to do, especially for owning a business, because again, in order for you to even establish a business, you need money. And if you don't have the funds, you're going to have to go do some kind of, small business enterprise loan or whatever that you want to call it, a small commercial loan, to a startup loan, usually they call it, to get you started, right? Maybe you need to get a business credit card for you to go ahead and buy all your supplies, equipment, whatever that you need to be able to run your business. Now, with the dangers of that, if you're going to be pocketing all your profits, the dangers of that is you're still responsible for all that money that you owe. Now, if you constantly are taking, and not paying off what you owe, your business can collapse very easily, okay? Just because, again, especially loan sharks or any bank, they're very aggressive when it comes to when borrowing money from them, right? If you don't pay, they'll charge you, lots of money, lots of fees, a lot of charges, okay? And if you choose to not ever pay, they're going to come after you, especially when, number 2, all business assets, okay, and personal assets are at risk, okay? So the number one thing when you do create a business is you must have some kind of collateral, okay? And especially when you start a business, right, you need something to back you up in case that you do take a loan out, right, and you fail to pay it, what is a way that the bank can, get paid their money back? And that is any means of collateral. So if you ever seen those movie shots where you got a nice hotshot businessman, and then next thing you know, months later, the bank comes and repossess their car, repossess the house, repossess a lot of things. That is it, okay? If you fail to pay your liabilities off, anything that is personal, as well as your business, anything that you own, which is an asset, is going to be at risk. Because again, you and the business are one. So if you create your own business, you share your personal assets and everything and so on and so forth. Okay? So again, yeah, it's a great idea to go ahead and buy yourself whatever you'd like, but at the end of the day, if you don't pay what you owe, they're going to come and repossess it, all right? And that is the huge risk of doing business, right? 100% of the liability falls on the owner's shoulder, and that means anything that's personal is going to be at risk as well, okay? Number 3, it's going to be limited to using personal savings or consumer loans. So again, you start a business, where's the money coming from? You need to start a business by having some kind of money. Now, especially because you are creating your own business as well, you are very limited to what options you can have, especially if you don't have any money. Now, again, you can use your house as collateral, but again, you kind of don't want to do that, right? So usually in order for you to start up your business, those small business loans are usually available for small businesses to, get their, startup package, right? A lot of companies out there are looking for, helping out those smaller business get well known by saying, hey, we can help you start up your company, right? By providing a small consumer loan. Now, again, we'll talk about loans and liabilities a little further down in the chapter, but that is a huge risk, especially if you have a huge responsibility and if you know that your business, right? When you do start your business, you're not going to generate profit within the first month because you have to buy all your equipment, you have to buy all your supplies, you have to, create your packaging, you have to market yourself. There's a lot of costs that's going to take for you to just get your business up and running before you could start. And though all of those costs, you have to pay back somehow. All right? It's not the easiest thing. And again, you need to start somewhere with money wise in order for you to kick off your business. Okay? And then number 4, doesn't attract high caliber employees, especially when we talk about a small proprietor, a small business, right? If you choose to have employees, you might not be able to provide for them, okay? When we say provide, we're talking about pay into their benefits, pay into their social security, paying into their Medicare, right? It might not be an option for you because we'll talk about this in chapter 12. What are the responsibilities and costs it takes to have an employee? And that's going to be one of the biggest expenses to a business because it's a reoccurring bill that is constantly on your back, especially when you have an employee work for you, right? Your responsibility is to always have to pay them at the end of their week, 2 weeks, whatever a payment plan that you agreed to pay them on. All right? If you can afford the benefits, right? Most likely, right? Especially for small businesses, you won't be able to pay them a lot because again, it's going to be a huge expense to the business. All right? And if your businesses are already suffering because you have to buy all this, buy all that, and you're pocketing all the profits, you can definitely for sure that those employees are going to leave your company because it's so small, right? You can't even pay for a 401k. You can't even pay me above the minimum wage. Okay? Et cetera, right? You can't even provide me insurance. And that is most cases because, again, a small business, you have to start somewhere and you can't put all your costs into employees because you haven't even got your business up and going yet. So it's definitely going to not attract very high caliber working because they're going to know that they're working for your company. What benefit are they going to get out of it at the end of the day? And last but not least, employee benefits are not fully deductible to the business. So again, because you're a small business, you're a sole proprietor, a lot of the deductions and benefits that you have to turn into the government are not fully taxable. So in this case, that's already a downside for you as a business, but then it's also a downside because especially not being afford to pay your employees is probably going to be one of the it's going to be one of the more things that you have to think about because again, if you're going to be the only person that's working your business, you might be working long hours and you're going to get tired. Okay. Anyways, any questions in regards to sole proprietors, the advantages or disadvantages? No questions?
Not so far.
Okay. So let's go ahead and talk about partnerships, okay? Now there are 2 types of partnerships, okay? We got the general partnership And then we have a limited liability partnership. Now, you'll mostly see LLPs often. Okay. Now, what's the difference between the two? A general partnership, okay, is where you have at least two or more individuals or partners that own the business, okay? And what those 2 to 3 partners, what they do is they're going to split up and divide the amount of responsibility equally amongst each and every individual, okay? Whereas a limited liability partnership needs to have at least one person who's actually running the show, taking full on responsibilities, while the other partner acts as a silent partner, right? Their mere responsibility to the company is to just invest, okay, and take profits. So again, 2 different types, right? You got one of them where everybody is involved, everybody has some kind of responsibility, some kind of, part to take in the business, while in limited liabilities, there's only one real person that's running the show, and the other one acts as an investor, okay? So again, most cases when you do end up being a sole proprietor and you are looking for someone who is to act as an investor to make your ideas branch out, most cases you do end up becoming a limited liability partnership, okay? All right, but that is the difference between the two. Okay, and again, all of these, right, they all have some kind of responsibility in regards to what the partnership entails. But let's go ahead and talk about the advantages and disadvantages. Okay. Advantage number 1 is, once again, it is also easy to establish the business. However, it is going to take some time because you have more than one person to involve, right? You have to go into contracts with each other because, again, you can't just say, you and I, let's go into business together and not talk about what your responsibilities are because, again, especially when you work with somebody, right, you're always going to have someone who's going to slack off, or you're going to have someone who doesn't know what their responsibilities are, and, you definitely don't want to be in that situation because then it creates arguments. But especially that, right, you have to agree on what the responsibilities are, what the profit distribution is, right? If you have 3 partners, is it going to be 30-30-40? Okay. You have to also think about, right, how do you partake in the actual organization? You need to have some kind of contract so then if someone breaches it, right, they can come back at you and say, hey, this is your responsibility. You signed this contract. This is what you have to do. So it does take time. Again, you never want to say, hey, you, me, let's go create a business, right? And you guys end up arguing and one of you guys decide to leave. And because you guys have no agreement, right, anything goes, all right? So again, it is a good advantage because you can establish yourself quite easily. But again, it does take a little bit of time because you have to rule out all of those aspects of who is this person responsible for and so on and so forth, okay? Ability to raise funds. Yes, because there is more than one of you guys can be able to create profits way more easier, right? So an example could be you got someone who can run the store, right? While someone can go travel from states to states or, be a sales representative and go door to door and get your product sold, right? You have the abilities to generate twice or even, 3 times as much income by having multiple people be able to, expand your business, right, by taking it on and generating the income in different ways, right? Number 3, again, it is 100% a tax deduction to you and your partner, all right? And number 4, hiring employees that may become potential partners. So especially when you have like a small mom and pop shop that do not have any lineage, they don't have any children, so it is potential that someone who is a very loyal employee, right, and the mom and pop, right, they're getting old, they want to kind of keep the shop running, but they don't want to work the shop anymore, then they could potentially select an employee to become part of their company. So introduce them and have them be involved as a partner in the company, okay? So again, that will attract a lot of employees who are those kind of high caliber and loyal because they have a possibility of becoming part of the business, okay? So those are all advantages. Now let's talk about the disadvantages, right? Now again, of course, if one person makes a decision, that means everybody has to agree on it, even for the bad decision. So again, if a partner makes a bad decision, well, you're just going to have to go through the motions and suffer along with that other partner because, again, all responsibilities for each other's partner's decision, again, even if it's a good decision, even if it's a bad decision, you are in a partnership, you have agreement terms. So again, you have to just go through whatever that person's decision is, whether it is good or bad. Okay? Now here's a fun fact. As a partnership, okay, let's say partner A and partner B, right? If there's an idea, or let's say they want to invest in something, right? If partner A has to run to the meeting while partner B has to go on a business flight, right? And let's say partner A has to make the executive decision and they go ahead and proceed with the investment. If partner B does not know anything that partner A has made a decision on, partner B can revoke it because both parties do not agree, okay? However, that means whatever partner A made the decision, it won't fall through because partner B doesn't know and they can revoke that, okay? However, let's say partner A and partner B, right, they agreed on it. They talked to each other beforehand, and then partner A once again goes to the meeting while partner B goes traveling, and partner A makes that executive decision and partner B knows about it, it is legally binding, meaning it will go through, okay? So that is a rule here. So therefore, if you have a partner that wants to undermine you, you have that legal right to revoke their decision if you have no idea that this decision was going on, okay? And again, all of this stuff is recorded, okay? And number 2, profits are shared. Nobody likes to share money, okay? It's reality, okay? Nobody likes to share money, especially when it comes to profits. So that's why you have to come to agreement terms saying, well, I did majority of the work, so I should get 60%. And if the partner says no, we should just do the work split 50-50, okay? And then we get the profits 50-50, okay? So if the company ends up making $100, each partner is only going to get $50. So think about it, okay? It is definitely a disadvantage because, again, everybody wants the profits all to themselves, okay? Number 3, disagreements. So again, always, especially when you have a partner, okay? You guys are always going to argue about making some kind of executive decision, right? Should I invest in this? No, no, you shouldn't because it's a waste of money. Yes, you should because it's going to turn around and make some more money. At the end of the day, as partners, right, you're going to agree on things, but you're also going to disagree on things. And at the end of the day, right, both partners must agree on something to make it legally binding, right? So again, a lot of disagreements can happen, especially if one partner has a certain idea and the other partner has another idea, right? And those two ideas are not one same idea. It can cause a lot of disputes and things like that. Okay. Number 4, some employee benefits are also going to be non-deductible. Again, because it's a small type of business, right? A partnership isn't going to be as a grander scale as a corporation, right? So usually small partnerships that are like this, again, some of those deductions for employees can be non-deductible. And again, number 5, it is going to be a limited life if a partner decides to leave, okay? Yes, you guys can go into contract with each other, but that also means you can either buy out the contract or in other sense, you can leave the company at any given time, right? Usually when you are in a partnership and someone wants to leave, they just have to either pay the other partner to buy out their contract or so on and so forth, okay? That means if you have two people and a partner decides to leave, therefore you have no choice, but you can either find another partner, or 2, you have to go settle as a sole proprietor, right? The criteria is you have to have 2 or more people, okay? You can't have one person running a partnership, okay? If you are, you need to be a limited liability partnership because one person's going to run the show while the other person just acts as a mere investor, okay? So in this case, it is going to be one of the more difficult types of businesses because, again, a partner can leave at any given time, which can force you into making bad decisions and going into a partnership that could not be a good partnership, okay? And yeah, all right. Any questions for partnerships? Okay, all right. So let's go ahead and talk about corporations, okay? Corporations, there are 4 unique characteristics that makes a corporation, okay? Number 1 is, well, besides that, right, you got shareholders, right? Meaning the company or the organization itself does not have one single owner. It has multiple owners, right? If you guys understand what stock is or shareholders, right? That is a means of buying a piece of the company, okay? Depending on how many shares or how many stocks you have, right? Usually they say if you have at least 50% of the stocks, you technically own the company, but that's not true. Because if you have 1 billion stocks, right, and you own half of that, right, which is 500 million stocks, right, that doesn't technically mean that you own the company. It just means that you own majority of the company, okay? But again, because there's 1 billion other people, right, or the other 500 million other people, right, who also own the business as well, right, we have to assume that when you do establish yourself as a corporation, it is going to be, the corporation itself is going to be its own separate entity, while the shareholders is what makes the company owned by various other people, okay? Number 2, there's going to be a central management. So again, central management meeting. The shareholders are going to hold a shareholders meeting at the end of the year or whatever that it is going to be preparing for the new year. They're going to elect individuals to become the board of directors, okay? So in this case, right, we got people who own the company, and then we got people who run the company, two separate individuals, okay? So in this case, there's a centralized government that allows the shareholders to be involved with the business decisions that need to be made when it comes to the actual corporation. Now, in this case, what the board of directors do is, after a certain point in time, when a decision needs to be made, they are the ones that are able to, again, be able to pull those executive decisions, because the purpose of, being a board of director is you have the trust of the shareholders, right? They're the ones who elected you, so they trust you in making the decision for the company, okay? Number 3, transferabilities of shares. So again, one of those decisions could be sharing the profit. So again, corporations, okay, that make millions and millions of dollars, right? Once they get that profit, right, the board of directors has to make a decision. Are they going to reinvest this money to create another division or create another component of the company, or do they choose to distribute their profits? Okay, so again, they distribute the profits through dividends. Okay, all right. So again, especially if you have 1 million people, right, that owns a share, right, the amount of money for dividends per person it's not going to be that much, but if they, constantly distribute profits all the time, you might be generating income that way. Okay. And then number 4 is going to be continuity of life will continue beyond the life of any shareholder, meaning even if there's just one shareholder or even if there's 0 shareholders, right? The company will still exist. However, it does need at least one person, right, to be able to manage it, but also to be able to own it as well. Because again, in order for an organization to operate, right, you need someone who runs it and you need someone who owns it. So in this case, it can last as long as there's at least one shareholder left. So if they went from 1 billion to 1, right, it could still continue being an existing company as long as there's just one person, okay? So in this case, because these are the 4 characteristics, right, how does a corporation become a corporation? Well, I can tell you this, it takes a long time to establish one because, again, most cases, right, when you are a corporation, you have to start somewhere. So, again, you're probably going to be starting as a sole proprietor or a partnership. So, a great example is if you look at the history of Target. Target was a small mom and pop shop. It got up to the point where people trust their products, people wanted to invest, and when it became invested, that's when they decided to establish in corporate status. Now, what does it mean to be incorporated? Well, a corporation, all right, is going to be considered corporate status when they file for, a change in organization, right? They want to become incorporated in the state that they are established in. So in this case, I don't know where Target is. Okay, I know they're somewhere in the Midwest or Mid-East, excuse me. But yes, right? It took them a long time to finally get incorporated, and it's going to be in the state that they established their business in. All right. So, advantages and disadvantages of a corporation. Well, number 1, okay, shareholders have limited liability. So again, when we took a look at a sole proprietor versus a partnership, right, they are limited to, their liabilities are 100% going to be responsible for, right? That means all their personal assets, okay, everything that they put into the company is at risk, right? But when you are going to be a shareholder, right, you're only limited to what your profit is or what you invested, which then goes into step 2, right? Meaning, if I invested $50 into Target, right, that means I'm only going to be at risk for $50. So if the company decides to plummet, right, that means I'm only at risk for $50. Nothing more, nothing less. Okay? So in this case, that's one of the advantages. That means if a person decides to just buy a whole bunch of shares and stock, right, the idea here is that they're only limited to what they invest. Okay? Nothing else. Number 3, okay, raise additional funds, okay, through sales of stock. So again, the number one thing that if a company or a corporation needs to, increase its money, how does it increase its money? Well, besides selling their products, right, they can do that by increasing their stocks. So oftentimes when you see a corporation, right, wanting to sell stock, it's just because they're either running out of money, or usually what happens is they have a 2-for deal, right? They say, oh, you could buy 3 stocks for the price of 1, right? So in those cases, right, you can own more and you can get back more, but you would invest more or invest less. Some way to entice you to want to buy into their stocks. Okay, and that is an advantage because again, that's how corporations raise their money, by selling their stock. Okay. Number 4, a tax deduction for having employees. Yes. Now, again, I'm not a tax accountant, so I do not know the actual parameters or what taxes you can or cannot take. But I know that it is for sure that you will get a tax deduction for having employees, especially for a corporation, because you are so big that it makes it, having employees, right, makes it able for the company to write them off, right? Huge tax deduction. Again, I'm not a tax accountant, so knowing the ins and outs of what you can and cannot deduct is not in my field, okay? But you can find out on irs.gov, okay, or seek an actual professional tax accountant, okay? And then number 5, you can elect to be taxed as a C Corp or an S Corp. Now, in this case, what does it mean to be elected as a C Corp or an S Corp? Now, in this case, right, if you've ever heard of this, what is a C Corp and what is an S Corp? They are not 2 separate entities, okay? They are the same thing. It's just going to be a corporation. The way that it's being taxed is what makes it different between a C Corp and an S Corp, okay? A C Corp gets taxed twice. Why? One at the personal income level and then one again at the corporate level, okay? So in this case, you're going to get taxed twice, whereas an S Corp, right, you can choose to be only taxed once, which is at the personal income level, okay? What benefits and what benefits is it to elect as a S Corp versus a C Corp? Well, straightforward, right? If you choose to be taxed more, you'll get more of your money back. But if you choose to get taxed less, then you may be subject to have to pay into the government, okay? Straightforward. In this case, especially depending on what kind of business you are, if you are major corporations such as Target, right, you're better off applying yourself as a C Corp than an S Corp because, again, especially cutting out all those extra taxes, there could be a point where Target probably has to pay into the government for all of these other taxes and so on and so forth. So why have to pay into it when you could just be taxed twice? Okay. Now that's just the advantages. Again, what about the disadvantages? Again, it does require a lot of time. So as I've mentioned before, right? Target didn't just miraculously become a corporation. It had to build its name, its brand, and so on and so forth. Especially because if you have shareholders who invest money into your company, you can't just blindly trust a company just because it's just there, right? You have to take time. And on top of that, you have to start yourself either as a small business or a partnership. Now, again, the only separate organization that can be filed as a corporate status already is if you decide to branch out and become a franchise. Okay, meaning you're still one corporation, but you're having a separate owner for this because it's another different branch, different company. That's the only scenario where you can become corporate status immediately. But of course, you need a lot of money for that. But besides the point, again, number one is it does require a lot of time because you need to, again, establish your brand, establish your customer, satisfaction, get people to trust your company, get people to trust your brand, your product, so on and so forth. Because at the end of the day, if people are willing to give you money, right, to expand your company, right, that's where the shareholders come into play. Because again, you're not the owner of the company. Everybody owns a part of the company. Why? Because they know this company is making money and they want to invest in it so then they can get some money back, right? So again, you need to trust, you need to build your brand to have people trust you in order for you to have shareholders who can trust you, okay, and want to invest in you. So in this case, you cannot become incorporated overnight, all right? It is definitely going to have to take some time. Number two, all right, monitored by the federal, state, and local agencies, okay? So again, corporations, right? You're always going to hear corporations are evil. Corporations are people who just want money and only. They don't care about anybody. All right? Yes, you can hear those lots of things. That's because, unfortunately, there are people who run their own corporations a certain way, and it looks like that to other people, especially because as a corporation, right, you have many reasons to want to, sweep stuff under the rug, right? And that's why it is heavily monitored by the federal, state, and local agencies. Especially, we'll talk about this later, further down in chapter 1. We're talking about the Sarbanes-Oxley Act, okay? Where a corporation frauded the government so bad, they cooked their books and they produced new books that were clean, meaning, they swept a lot of the money under the rug and didn't report it. And that's why, again, right, what is one penny to a company, to a corporation? It's nothing. It's a speck, right? What is $50 to a corporation? That is also nothing, right? Because if it's $1 billion company, again, what is $10? What is $50? What is $100 to a corporation? It's chump change. So again, these things, they can easily get swept under the rug, and that's why it's 100% really heavily monitored by the federal, state, and local government, just because, again, corporations have that connotation that they are trying to cheat the government, try to save money on taxes, and so on and so forth, okay? And then again, number 3, higher taxes if they are taxed at C corporation level. So again, that is a disadvantage because then you have to pay more taxes. But at the end of the day, again, we talked about this, right? If you are a major corporation, you'd rather pay double the tax so you could get some money back, or would you rather take the shortcut, only get taxed, and then have to pay a huge lump sum at the end of the deal, right? Any questions in regards to corporations? No? No questions? Ooh, whoa. Okay.
No questions.
Okay.
It's a lot to take in.
Mm-hmm. Don't worry, I'll tell you what you need to know and what you don't need to know. Okay. Limited liability companies. Okay. What is a limited liability company? It is actually a hybrid between a corporation and a partnership, right? It must carry a few features that are an essence of a corporation, but not all of them. Usually it's only about two components or two characteristics, and it has to at least have two people, okay? But it is not a corporation itself. It is a legal entity. It is a small business. However, it has the capabilities of having those two unique characteristics of a corporation. Okay, so if you remember, out of these four characteristics right here, the limited liability company must select two out of them. Okay? Now they can choose, they can have stockholders, they can have some kind of central government or some kind of feasible way to distribute money, or they have some kind of longevity in life, right? One of the four components. Okay? So, what is the difference between any other company and a limited liability company? Well, let's talk about the advantages and disadvantages first, because we already said, right? The difference is it's a combination of two different organizations, right? But it's not an actual corporation. It is its own separate small legal company, right? So number one is it is going to be able to get taxed at S corporation. Okay, so again, has some flexibility, all right? Meaning, because it's a smaller company, it's not anywhere near the corporate status, it has the possibility to be taxed only once. Because again, it's a characteristic, right? It is part corporation, but not really. So in this case, they can only get taxed at the personal income level. Okay? So again, huge advantage because again, they don't have to get taxed twice because they are a smaller type of company. Okay? Number two, limited liability. So again, right in its name, limited liability, meaning it has the same key features, right, as a corporation, right, where whatever individual wants to invest their money into the company, that is all they're limited to. They are not obligated to have their personal assets at risk at all, right? Where a corporation, right, is very similar to a sole proprietor. They must invest their own individual stuff, and they must have their own collateral to be able to run their own business in case it fails, right? That means their personal assets are at risk. But when you come into a limited liability company, nope, your assets, personal assets, are safe. Okay? Number three, can elect members to be the entity. So again, right, because in this case, when we're looking at a limited liability company, right, you can choose someone to just become or be the actual company. And of course, the benefit to that is, you know, the other partners or the other individuals that are in the company, right, they don't have to take full responsibility, right? Number four, okay, no annual shareholders meeting is necessary. So again, with a corporation, right, they must have those shareholders meeting for reasons to, one, elect the board of directors, but also to be involved with the decisions that are necessary to be part of that business, right? In this case, your limited liability company isn't a corporation, right? You still have the ability to elect your board of directors. However, those board of directors are going to make those decisions without having the organization, without having the shareholders involved. Okay. And then number five, less administrative work and record keeping. So again, when you are a corporation, you have to do a lot of recording. So in this case, it's limited, okay, or it's not as much as a corporation would have because it's less paperwork. In this case, you have less paperwork. Number 6, memberships interest can also be assigned. Okay, so in this case, when you do become part of the organization, what are your responsibilities that you could be assigned is what this section is. Okay, so again, because it's a mix between a partnership and a corporation, right? Your partners can be involved in the company, but you can assign those memberships and what they do. Right? The disadvantages of a limited liability company is you need to have at least 2 individuals or 2 people involved, 2 owners. Okay? You cannot exist because once again, it's a partnership / corporation, right? It did not say a sole proprietor. All right? So you need to have at least 2 people. Okay? Number 2, can have, okay? Limited lifespan because again, if a partner leaves, well, then you have to you can't continue doing business because you need to have more than 1 person in the company. Okay, so if you have 3 people and 1 person leaves, you're still fine. Okay. All right, number 3, may have self-employee taxes. So again, as a limited liability company, once again, because you are a partnership, you are considered a small business, not a corporation. You do have the employment tax that you may have to pay, right? Number 4, okay, if profits exceed 50%, it will be taxed by the federal. Okay, so again, limited liability companies, they're generally not supposed to make that much money, but if it does exceed more than 50%, then it will be taxed by the federal government. So again, we talked about the personal income tax. This is when you get profits, and usually profits are taxable. So in this case, if it does exceed more than 50%, it will be taxed. Okay. Cannot take advantage of stock options. Okay. Now, I'm not sure if this is true for all LLCs, but for a limited liability company, you cannot own your own shares. Okay? So that's what a stock option is. A stock option is when you do work for the company, and what happens is they give you an option for your retirement plan, right? You have the option to obtain a few stocks, like you own a part of the company. So then when you do retire, right, those stocks are available for you to redeem for your retirement. Okay? In this case, right, because it's a limited liability company, right? It's not as a grand scale as a corporation is. If you work for the company, you cannot take advantage of owning the company, right? Number 6, some states actually tax LLCs. So in this case, maybe, again, LLCs, right? I'm not a tax accountant. I'm not quite sure what these taxes can be, but most states do tax them, right? Especially you just have to look up what states that don't tax LLCs. All right, but again, most of them, it's usually most states do tax LLCs. Okay. And then number 7 is if you're deciding to convert from a sole proprietor, or not sole proprietor, a partnership, right? And you are going to establish yourself as a limited liability company, you can be taxed for making that conversion from a partnership to an LLC. Okay, so those are all going to be disadvantages because then you have to pay more for being an LLC. Okay, even though you get taxed one time, right, at the S corp level, right, you have other taxes that are going to be prevalent, right? Any questions in regards to LLCs? Okay. All right. Last type of business organization is going to be a non-profit, or also known as non-for-profit, whichever one you know it as, NFOs, or NPs. These type of organizations have one goal and one goal only. They are here to educate. Okay, again, hence the word non-for-profit. They have no business in wanting to generate any kind of income. Okay, they don't want to earn any profits. However, these type of organizations have one goal, and that's to educate. Now, what are the topics that they can educate? They can educate for cultural beliefs. They can do, educational beliefs, professional, right? Religious purposes, okay? It could be even something medical, something to spread awareness. So again, the main goal of this organization is to come together to spread some kind of awareness for some kind of cause. So as you can see here on the right side, we got PETA, right? Not us PETA, but the animal PETA, okay? The protection of animals, okay? We got Comic Relief for AIDS, right? We got the Susan G. Komen for breast cancer, and we also got St. Jude's Children's Hospital, which is cancer research for children, okay? Okay. These are all organizations that have one goal, which is to spread some kind of awareness and some kind of belief, right? To educate, once again, for a cause. Okay. Now, again, these type of organizations have no owner. Okay. They don't have an owner. And these are all purely based on volunteers. Okay. Meaning, since no one owns the company, then who is involved in the company? And that's going to be volunteers. Okay? You're not obligated to be part of this organization. You have to volunteer on your own terms. Okay? And how are these usually funded? They are funded by the members themselves. So again, every nonprofit organization, right, has some kind of membership due, okay, or some kind of fee for you to be a part of the organization. Other things could be contributions. So again, a great way for a corporation to make themselves look really nice and good and look like they care about the environment or care about the community, right? They decide to have contributions to one of these organizations to say, hey, every dollar you spend at McDonald's, right, we put it into the Ronald McDonald Fund, which supports kids and their education. Okay, whatever. Okay. Or if you, every dollar that you spend at this organization, right, we will plant a tree in the forest out there. Okay, whatever they want to say. That is what usually contributions are going to come from, is from those major corporations that involve or invest a portion of their money to the cause or to these type of organizations. So that's how they can get money. Other things could be fundraisers, right? Again, every year, I believe, like LA AIDS Walk, they always do it. Every year, they close down one of the streets in LA. And again, closing down a street costs a lot of money because it causes traffic. It means a lot of, not good for business because no one's able to park there. However, again, this is a fundraising event. It's to put on, spread awareness, show support, but this is where donations are collected. This is where a lot of the, individuals who are involved in the corporation, involved in this company are going to be generating some kind of way to fundraise the money, and it's going to go straight to the organization. And again, even federal state grants. Again, a lot of times, a lot of the states or even the federal organizations, federal agencies, right? They decide, well, we have a whole bunch of money left over. we're going to give it to this company to go ahead and invest into another company. So again, again, they could, the state can agree, hey, since this organization was established here, we're going to give a generous donation or to give a federal grant or a state grant for these organizations. Okay, so they have many ways that they can collect money. And again, they're not doing it for the reason of making money. They're doing it so then they can get the supplies, get the marketing materials, get the shirts, get those, marketing materials, marketing, gear to help have one goal, which is to spread awareness. Okay, especially when all of these monies, right? If it's going to St. Jude's, which is to research for cancer, right? That is where the money's going. Now, of course, it also is going to the individuals who are running the organization as well, right? Not everything is really pure voluntary, okay? And then, of course, there are special taxes because since they are not in the business for making money, they have a special form of taxes that they must go through. Once again, I am not a tax accountant. I do not know what the parameters are for actually being a nonprofit type of organization. However, there are special tax just because, again, they're not in it to make the money. However, if they are getting donations, right, that's free money. Again, that is 100% taxable. Okay? Same thing with federal grants and everything like that. That's money. That's free money that's given to this organization, so they will get taxed for that. It's just like winning the lottery, right? That's free money that people pull in, but at the end of the day, when you walk away with that money, you get taxed because, again, it is free money, all right? So again, this is the 5 different organizations. Anybody have any questions in regards to those 5 different organizations?